Hi, and welcome to the Stock Scores Market Minutes for May 23rd, 2016. This week, how to trade reward for risk. Before I get into that, let me just highlight the webinars that I'll be doing this week. This Saturday, meaning Saturday, May 21st, I will be doing a webinar, 3 strategies for profit in the market. I'll show you a day trading, a swing trading, and a position trading strategy. So if you are watching this video Friday night, you can participate in that strategy session on Saturday. Monday, how to grow your retirement portfolio. Obviously, I can maybe spell portfolio a little better. Thursday, how to make stock trading a career. And then next Saturday, how to get the most out of StockScores.com. I'll go through all of the different tools and services of StockScores and highlight them. To register for any of these free webinars, go to that address right there, StockScores.com/webinars. All right, let's get into this week's topic, how to trade reward for risk. Buying stocks that are going up is important. However, where you buy relative to where support is has an important impact on total profitability, assuming that you use support to mitigate your risk. You maybe have a stop or you plan to exit somewhere around support. So it's important then to consider where you are buying relative to where support is. And sometimes you can actually pay a higher price for the stock, but that can ultimately lead to bigger profits because of the proximity of your entry price to support. Here's a day trade from Friday, today, the day that I'm doing the video. And we see here that CLRB erupted with some abnormal volume right from the get-go. And, you could probably catch this trade pretty early in the day, right around there, let's say at $1.60. Well, at that point, support was down here at an inflection point at around $1. So pretty significant difference between the entry price and support. If you waited until later in the day when you had the break of the flag pattern right there, well, now you can enter at $2 with support at about $1.80. So there you've got 20 cents a share in risk. Here you've got 60 cents a share in risk. So even though you buy at a lower price here, you have more risk, which means your position size is smaller. Here you're paying a higher price, but because you've got a new floor put in at that inflection point, your risk is only 20 cents, which means you can buy 3 times as many shares, which ultimately makes you more money on the big run higher. I'll be talking about this trade in Saturday's webinar, Saturday, May 21st. All right, let's get into this week's analysis. S&P 500 has been drifting for almost a month now. You can see we've got the downward sloping channel. We are at the top of the channel on Friday's close. Could lead to a break of the channel Monday morning, but for now we remain in that channel. So this is I'm going to call it a neutral chart because we're pretty close to support here, but it is trending lower, so it's on the negative side of neutral. Longer term, we know that the market has hit resistance at the old highs. We've been drifting lower ever since. We have to really watch this chart closely because we are shaping up here for one of two things. One, we could break this pullback, in which case we're going to try to make a stab at breaking through resistance. The other option is that we've got a head and shoulders top building here with a neckline right there. If we break that neckline, I think prices go lower. So you want to keep a close eye on that. On Thursday, we were actually below the neckline in the morning. I put a tweet out at that time saying if we close down here, if we close at the lows of the day, then we will have a break through the neckline of the head and shoulders pattern. It didn't happen. The market has held up and moved higher. Now moving on to the Russell 2000, you can see also a little drift here over the last few weeks. Big term or longer term picture, we've got falling tops. So that's a negative chart, but we're really close to that downward trend line. And so if we could break to the upside, well, then we negate the fact that we've got those falling tops. Until that happens, I want you to stay negative on the small cap US stocks, but we are at a point where we could break into a positive break of trend very easily. On the Toronto Stock Exchange, we've basically been going sideways for the last month or so, pardon me. We've got some little rising bottoms in here. That points to possibly a break out of this area, but until we get that break, don't get too optimistic. This is a neutral chart for right now. Longer term, broke the downward trend line, building rising bottoms. This is a positive chart, but not extremely positive because we're stuck at this resistance level right now. It is consolidating upwards toward that. So I would say it's on the positive side of neutral. On the TSX Venture, great returns over the last few months as the gold miners have really pulled this market higher. And it's not just gold, it's lithium, it's other mining stocks, but certainly there's been a rejuvenation of the TSX Venture market. It's risky because of the gains so far, but until you see this trend line get broken from a falling top, you want to stay optimistic on the small cap or micro cap Canadian stocks. Treasuries broke down on Wednesday on that minutes announcement from the U.S. Federal Reserve. Some discussion in there that interest rates may get raised in June. The market still only thinks that there's a 30% chance of that happening, but we do have this longer term pennant pattern, and if we break out of this pennant to the upside or downside, that'll point to where the market's going to go. This week's action was down. That means interest rates went up, but it's not out of the pattern yet, so I don't think it's a cause for too much concern just yet. US dollar on the news of the week with the minutes from the Fed. US dollar got a little bit of strength. That weighs a little bit on commodity prices, but it's far from a positive chart. This is really just a chart that's kind of stuck in this slightly downward sloping channel. I do think we could see this come up into here. So that's some upside in the short term. Maybe the next 3 or 4 weeks, we could see it move higher. But it's not like it's starting a trend like we had back here where you're going to get dramatic increase in the US dollar. Until it can break out of this channel that it's been in for some time, I wouldn't get too worried about the US dollar rocketing higher. Gold felt the strength of the US dollar. You can see gold had a little bit of a negative move this week. It hasn't broken down through support. We talked about this breakout 4 weeks ago from a rising bottom. That still remains intact, but we're kind of stuck in this range. I'd like to see this start to break up here, and that would be a continuation of that longer term trend. We're basically stalling underneath the resistance from January of 2015. On the oil market, hey, we've broken the long-term downward trend. We are meandering higher without a lot of exuberance, without a lot of excitement, but there's no weakness, at least that's the first time in a long time that we can say that the market is stable for oil. It doesn't show any excitement really. It's just kind of drifting higher. And what's interesting, it was able to do that despite the fact that the US dollar was strong this week. So it's a slightly bullish chart, not a lot of excitement there yet. Fear tried to take a little rally on Thursday, failed, fell back on Friday. We remain sort of in this no fear zone down here. But notice that the pace of the downward trend is rounding, and that shows us that complacency isn't getting worse, but we're not yet seeing fear. So I think the market's just stuck at that longer term resistance. So my ratings, I've got neutral ratings on both US and Canadian stocks. I would say Canadian stocks look slightly better. Remember I said that we were on the bullish side of neutral for the Canadian market longer term. Gold, I've lowered my ratings to neutral just because of that spike in the US dollar last week. Kind of stalled the rally in gold, but I don't think it's bad yet. We just have to be cautious with it. I'm bullish in both time frames for oil, but not extremely bullish. As I said, the market is trickling higher. It's not doing so with a lot of excitement. Stocks rebounded well from the interest rate worries that were raised on Wednesday and continue to fight with that resistance without any strong selling pressure. We want to watch for a break through either support at the little downward trend line that's been building on the S&P or through resistance, which is the top of that flag pattern on the S&P 500. Gold pulling back on the US dollar strength, but oil really shrugged that off, and that's a positive. Fear remains low. So in this environment, I want you to be cautious. There's not a lot of great opportunities. Be selective, be patient. Remember to follow me on Twitter. Remember to subscribe to this YouTube channel. Have a great week in the market and trade well.